everyone, PS from PS Invest Plays here today. Since March 2020, Salesforce stock has risen 130%, and year to date, it has risen 39%. But since November, it has shed 14%. Has the stock peaked? Or can we expect higher stock price in the future? In this video, we will understand its business, its financials, its future growth outlook, and review its chart using Elliot wave to see how we can make money. So, stick around. I think you'll like what I have in store for you today. Salesforce, ticker CRM. Salesforce is an American cloud-based software company headquartered in San Francisco, California. It provides customer relationship management service and also provides enterprise applications focused on customer service, marketing automation, analytics, and application development. Collectively, that suite of products helps businesses manage and deploy customer data in a way that drives sustainable growth. It serves a wide range of industries, ranging from financial services, healthcare, manufacturing, retail, to public sector. It boasts a large list of large, small, and medium companies as clients, including blue-chip organizations such as RBC, PayPal, Coinbase, Sonos, Honeywell, Cigna, Northern Health, Target, Lowe's, IBM, Marriott, the cities of New York, Chicago, and Austin, among many others. Salesforce is the dominant leader in the customer relationship management or CRM market by a wide margin. Its 19.5% market share is about 4 times that of number 2 players, Oracle and SAP. Research from Accenture, an IT consulting firm, showed that before 2020, leaders in digital transformation grew 2 times faster than digital laggards. The 2020 closures had forced companies to increase spending in technologies that quickly add value in a world in which the shift online has accelerated. Accenture estimates that the achievement gap between digital leaders and laggards has widened to 5 times post-2020 and poised to widen even more. Data from Salesforce corroborates this observation, showing that worldwide GDP driven by digitally transformed enterprises has doubled but shrunk for non-digital enterprises. With leaders stepping up their investment in technology and innovation, worldwide digital transformation spending is expected to increase by 35% or 16% per annum to $1.78 trillion in 2022. As digital transformation laggards are forced to jump on the digital transformation bandwagon and spend to play catch-up or risk extinction, IDE expects digital transformation spending to increase from $1.78 trillion to $2.39 trillion, another 34% or 16% per annum between 2022 and 2024. In its 2021 Investor Day presentation, Salesforce management raised its calendar year TAM, or total addressable market, to $248 billion, up from the estimated $175 billion TAM communicated in its year-ago Investor Day presentation. This was driven by the acquisitions of Slack and Velocity, which expanded its industry vertical reach, as well as higher organic growth from acceleration in digital transformation. As a result, the compounded annual growth rate of Salesforce TAM ticked up to 13% per annum, up from 11% per annum in the previous year's estimates. Each of Salesforce's many categories, sales, service, marketing, commerce, cross CRM, analytics are expected to see four-year double-digit CAGRs. The underlying demand for Salesforce's categories should drive strong revenue growth for many years to come. Salesforce has grown organically by number one, winning new clients who spend to avoid falling behind competitors in the race to win more customers. Number two, cross-selling additional products to clients using a land and expand strategy. Number three, international expansion. And number four, introducing new innovative products and capabilities. As Salesforce's clients pay annual subscriptions for the right to use the software, the company enjoys the stability of recurring revenues. Also, Salesforce has made several sizable acquisitions, for example, MuleSoft, Tableau, Slack, and others, to expand growth. Salesforce's revenues have grown substantially over the last decade, and the company boasts of being the fastest among large software companies to reach $5 billion, $10 billion, and $20 billion since founding. It expects to be the fastest to reach $50 million by 2026. Salesforce has additional growth levers to share gains. The company has historically been great at adding new verticals through its application plus platform ecosystem to grow its TAM. I expect this to continue. New geographies will also be growth drivers. Salesforce's international operations are growing faster than its North American ones, and this should continue to be the case for the coming years. Putting it all together, I would think that Salesforce should find it relatively easy to grow at double the speed of its market. The SaaS or software as a service sector is one that is not subject to the law of diminishing returns. On the contrary, it benefits from operating leverage arising from several factors, including number one, the ability to spread R&D and software development costs over more clients and revenues. And number two, fixed overhead costs do not scale up at the same rate as revenue growth. Empirically, this has been true at Salesforce. Its EBITDA margins have increased from 9.4% to 17.1% over the last 5 years. Salesforce has similarly experienced an improvement in its unit economics, or the profitability for each dollar of revenue. The increase in unit margins is driven by the reduced attribution, lower cost to serve every dollar of revenues, likely due to scale, operational efficiencies, and lower technology costs, partially offset by the uptick in cost to book, that is, the cost to acquire revenue. On the whole, unit margins have expanded over time. According to Deloitte Consulting, data at scale is one of the biggest and most important opportunities for companies going forward. In the future, large data platforms should have natural monopolies that benefit from the network effect and are in a good position to extract and control data, which they can use to train and apply their machine learning algorithms. Companies with lots of data are in privileged positions. Their competitive advantages accelerate with more data and scale, and they can evolve into more generalized AI companies. Salesforce is reportedly working on and funding the use of AI technology in a broad range of applications. Einstein, Salesforce's AI technology. Einstein's global models for opportunity scoring can use aggregated, anonymized trends across Salesforce's platform to empower teams with AI before they have enough of their own data, and can be trained and refined using the vast amounts of data to improve the over $93 billion AI-powered daily predictions and post-call action items provided to clients each day. Salesforce's access to the massive trove of data solidifies its privileged position and competitive advantage to make better predictions that add more value to its clients. As more people in an organization are trained and get accustomed to using Salesforce software, and as the number of customer records grow, the software becomes ingrained into the daily workflow and becomes increasingly difficult and risky to replace. More recently, Salesforce announced plans to integrate Slack into its product offerings. One of Slack's most important features is its shared channel capability, which establishes and enables real-time connections between a client's employees and external parties such as suppliers, customers, partners, and other stakeholders. When multiple external parties become accustomed to communicating on and running apps on a platform like Slack, it becomes even more difficult to replace the platform, which brings the stickiness to a new level. For Salesforce, historically per share TTM, trailing 12 months revenue growth, has been in the mid-teens. EBITDA margins have expanded over the last 5 years, while the free cash flow margins have hovered around the 2 and 2.5% range. Management has guided fiscal year 2022 revenue growth to 23 to 24%, which, when adjusted for the year-over-year increase in shares, largely due to the Slack acquisition, results in a still strong 19.4 to 20.3% revenue growth. Management has increased its fiscal year 2022 revenue and operating margin guidance 3 quarters in a row. My biggest worry with Salesforce was always its focus on sales at the cost of margins. The company had always seemingly prioritized revenue growth with its massive sales and marketing spend. Salesforce has historically spent an incredible 55% of its revenues on SG&A, which dramatically shrunk its margins. The company's revenue growth had always been top of mind, but its profitability has been out of focus. Now, though, the focus seems to be changing. The company initiated a 20% operating margin guidance for next year. The new target isn't just well above the 19%, but indicates 150 basis points of sequential improvement in the face of 125 to 155 basis points margin dilution effect of the Slack acquisition. This indicates 300 basis points of core margin improvement in Salesforce and is completely unexpected and is a key positive. The change in focus was apparent in the management commentary and the presentation. The rising margins are to be enabled by cost discipline, which is a huge change in tone. The management mentioned profitable growth several times. The new focus will be on unit economics instead of driving every last bit of revenue growth. The company looks to both capitalize on the strong demand environment and several cost initiatives to drive better economics. The margin increase is to be driven by a falling cost to serve and lower attrition rates. Salesforce expects that it can sustain its 2020 era online sales meetings in the future. This is critical as face-to-face meetings both cost more in terms of expenses of the sales staff, but also are a much less efficient use of sales staff time. Moreover, renewals instead of new sales should drive margins as well. The sales effort required in renewing a contract is typically much lower than the acquisition cost of getting new business. I see a clear path to 35 to 40% operating margins over time as sales and marketing costs decrease or scale. Salesforce spent 44% of its revenues on sales and marketing over the past 12 months. This is by far the highest in the peer group. However, Salesforce isn't the fastest grower in the group. Its year-over-year growth rates is very similar to Adobe, and well below ServiceNow despite much higher spend. I believe that over time, with the management's new focus, Salesforce's cost structure will be more similar to its peers. Salesforce has historically often engaged in sizable M&A deals. The management took this off the table and said that the company has no appetite for large acquisitions. The company will instead focus on integrating current purchases. This should drive cross-selling revenue upside as well as cost synergies and reduce further dilution of its shares. Looking at the financials for Salesforce, revenue, gross profit, EBITDA, net income, EPS or earnings per share are increasing quarter over quarter and year over year. Even if you discount 2020 and compare 2021 financials with 2019, they have increased by a very good clip. In the chart on the right, free cash flow or FCF currently stands at $5.79 per share. Based on the current price to FCF ratio, the stock is trading in line when compared with historical averages. In the chart on the left, price to earnings or PE ratio currently stands at 83.10. Based on the current stock price to EPS ratio, the stock is again trading in line when compared with historical averages. Salesforce trades at a discount when compared with its peers. Adobe trades with a 17.9x EV forward revenue multiple, Autodesk with 15.5x, and ServiceNow with 19.6x. Salesforce is well below its peers with a multiple of 10.5x. Revenue growth rates don't account for the valuation gap. The next 3-year CAGR expectations for the companies are 19% for Salesforce, 14% for Adobe, 16% for Autodesk, and 24% for ServiceNow. The market is discounting Salesforce because of its thinner margin profile. Salesforce's margin expansion should catalyze price action through a larger multiple. As Salesforce delivers above consensus margins, I expect investors to re-evaluate their long-term models to award higher multiples for the name with bullish long-term margin assumptions. I believe that rest of the market will begin to see the long-term 35 to 40% operating margins over time. And as Salesforce margins expand, its valuation discount should narrow. I think investors who have a long-term investment horizon should take this opportunity to buy the dips. This is also indicative in the charts where I see the stock price to experience some pullback before it increases considerably in the next 5 to 6 years. Now, let's take a look at the chart for Salesforce. Sorry for the interruption, but I wanted to take a moment to remind you that if you like this video, please don't forget to subscribe, hit the like button, and hit the notification bell icon so you're notified when I upload a new video. With that said, let's get back to our analysis. Looking at the chart for Salesforce, the bull run that started in 2020 is still not over. It has completed its first wave, and wave 2 seems to be coming to an end. Due to macro conditions, its stock price can go lower. I see strong resistance around $236.64 and strong support around $213.37. After this correction is completed, I expect wave 3 to resume, which is typically 161.8% of waves 1 to 2, giving us a short-term price target of $571.10. After wave 3 is completed, I expect wave 4 to resume, which is typically 23.6% retracement of wave 3, giving us a short-term price target of $449.31. After this retracement is completed, I expect wave 5 to resume, and wave 5 is typically 161.8% retracement of wave 4, giving us a final price target of $645.86, which translates into a 165% profit in the next 5 to 6 years. Now let's summarize. For Salesforce, the current stock price offers excellent entry point. I would recommend nibbling any pullbacks and accumulate corrections. For me, the accumulation range is a price between $213.37 and $236.64. I recommend holding Salesforce stock for the next 5 to 6 years, as I expect a price target of $645.86, which translates into a 165% profit in the next 5 to 6 years. What do you think of this analysis? Please leave me a comment and let me know. As always, please don't forget to subscribe, hit the like button, and hit the notification bell icon so you're notified when I upload a new video. Until then, bye-bye.